Hey everybody, it's Chris with Life 180, and I'm here today with Galen from Canadian Whiteboard Finance. And today we're going to be talking about ultimately the different ways that you can utilize whole life insurance. I guess not just the different ways, but the different kind of phases of life where whole life insurance is applicable and how it's applicable at those different stages of life in Canada. Does that make sense?
Absolutely.
Okay, rock and roll. So I'm really excited about this because I mean, you obviously know if you've been watching these videos, I'm a big believer in whole life insurance as an asset. I use it for me, for my family. I'm a big believer that everybody, I think the world would be a way different place if, well, I was actually talking to a guy the other day. He's like, well, imagine what the world would look like if every child born was not only given a birth certificate, but a $100,000 life insurance contract with cash accumulating, like a maximum funded optimized whole life insurance contract from the day that they were, a couple of weeks old where they qualified for life insurance and went from there, right? Like it would be a pretty amazing like shift in the way that people handled their personal finances and the leverage that they had and the different resources and mindset and the education that would go around it and all that stuff. So, I mean, you have that end, and then you have people on the other end, right, that say that they're too old to get life insurance, or maybe they question if they're too old, right? So those are kind of the opposite ends of the pendulum, and then we have everything in between. So I think what I'm excited, Galen, in this conversation to walk through is talking about what does it look like at the beginning? What does it look like towards the end? And what does it look like kind of in the middle, and all the different use cases? And I know that's a lot to cover in a short period of time, but like, let's try to at least give an overview of it. And if anybody has any questions, they can subscribe to the channel, click the bell, get notified. That way, when we do more videos on this in the future, you'll be made aware of it. And if you ever want to talk to Galen, there'll be a link below. You can use that link to set up a time with him, and he'd be happy to talk with you.
Absolutely. Yeah. And I mean, I love what you said about how the world would be a better place if everyone owned this from the get-go. I totally believe that. I firmly believe if I had a magic wand, I would just like bippity boppity boop and everyone would own this stuff. Like, and I just do
Yeah.
something else with my life. Like, it's fine. Like, if everyone had, I'm a firm believer, if every kid had whole life insurance, if every kid had critical illness, and like a generation just did that, like if it was just there in place automatically, like first off, and I'm going to tread very lightly here because I can't remember if we've talked about this or not, but like when a GoFundMe pops up in my network of someone or on Facebook or someone in my town, and I'm going to tread lightly because people I really care about have used GoFundMe to pay for things, unexpected expenses because of death or because of illness.
Mm-hmm.
And I think it's a beautiful thing when people rally together to help someone. I really do. I also look at it as I've put so much in place around my life and my kids and my family that I don't think I'll ever need a GoFundMe if anything ever happens to any of us when it
Mm-hmm.
comes to health and life. So I'm in a position to potentially give to GoFundMe's rather than have to take it. And I'm not knocking it. Like if people need their community, they need their community. But that's what I just think about is like, God forbid something happens and one of us gets sick or
Mm-hmm.
passes away, like we've got a check coming to us that's going to take care of the money side of what we're dealing with to give us the freedom to deal with the emotional side of
Yeah,
what we're dealing
totally.
with, like on all levels. So that's part, I absolutely agree, same thing. Like, I mean, every time I see a can that people are collecting change with a picture of a kid on it because they're sick, I just think, man, if they'd had critical illness or if they'd had something in place. So what I'll talk about today though is I kind of like the bookends of finance of whole life, like, and it's
Nice.
actually spurned on by a conversation. Someone booked a call with me from the link below and was asking me like, Galen, like I won't go into too many details because I do like to respect the privacy of everyone who calls me, but it was basically a guy with, it looked like he probably needed his parents to get some life insurance, and it probably made sense for his kids to have some life insurance, and even himself. And so he was kind of asking me like, is it a good idea, or is it too late, or is it too early? And so I'm going to talk about that a bit, and
Okay,
just like, and
perfect.
then a thing that dawned on me after we spoke and I just emailed them is if you can enable sharing real quick, I'll probably do a
Oh yeah.
drawing.
Yeah, good.
A thing that I sent an email and I'm like, yeah, I mean, I don't, without giving me the particulars, I don't know exactly how much you need or what kind you would need. But then it hit me. I was like, oh man, I like reached back out to him. I'm like, you need to make sure that this gets structured the right way, because it just dawned on me at the last minute. Like I was driving today, kind of thinking about what we were going to talk about today. And then it just hit me like, oh my gosh, I really need to make sure he does this the right way. So I'm going to talk a bit about too, like how to do it the right way. So you can see the whiteboard, right?
Yep.
Perfect. So what I'm thinking about, like, there's this common term out there, like the sandwich generation, which actually is what this made me think of. And so sandwich generation, if anyone doesn't know it, is like someone who's in like usually like 40s, 50s. Their parents are maybe starting to need some help and their kids are still at home. It's like this generation that's getting kind of sandwiched between needing to take care of themselves and their parents and their kids. I don't know for sure if that's the case for this person, but it kind of made me think of that. So he's got his mom who, he's like, okay, I'm thinking about, she might need some insurance. And then it's like his son, or he's like, I want to set him up for success. And so he has it because his parents set it in place for him. So it's like, I'll just call this the dad, and I'll call this the grandma, and I'll call this the son. He has it because his parents set him up as a kid for it. And he's like, it probably felt like a lot back then because like I'll meet people, it's kind of fascinating. Like I'll meet people who are like in their 80s that still have life insurance kicking around, and they were paying like $5 a month back in like, 1940 or something like that. And back then that was probably like a lot of money, and like now it's like, well, that's not a lot. But the cool thing is the death benefit has kept up with the demand. And so it's really interesting to watch that. So I'll talk about like what people are dealing with where it makes sense. And if it's too late, like I have seen it make tons of sense for people in their 70s to get whole life insurance. Like I actually see this commonly because a lot of people at that age have a lot of money saved up in a highly taxable environment. So like if I meet someone in that age group, so 70s, I'll just say 70s. If I meet someone in that age group, like the things that they have saved, like this is kind of what it looks like, is like the taxable versus the non. Most of what they have is in a highly taxable environment. So we talk about moving it over, like moving it from, I'll just reset. I'm moving it from the taxable to the, moving it from the taxable to the non-taxable. And that's basically what people are doing with life insurance, is you're taking money that could grow and get taxed down the line, and you're moving it into the non-taxable bucket with life insurance. Another interesting case that was presented to me around this was there's a family business at play. So depending on how you've structured your shares, depending on how you've structured your company, like there can be tons of capital gains when a business changes hands, especially if a business has been grown from zero. Like grandpa was an entrepreneur. He started a business that has an initial starting value of $0. Like a lot of businesses kind of have this, where it's like, yeah, whatever the business might be, like it might be a metal fabricating. Like I've seen locally, we have a lot of fabrication, like industry type stuff around here, like people who are creating metal parts for companies, or people who are creating raw materials for
like machining type companies.
Yeah, machining, exactly. A lot of machining companies in this area. And what I commonly see is like the grandpa was an entrepreneur. He saw a need to create this. He created it from zero, from scratch. Fast forward 50 years, from his 20s to his 70s, this company might be worth like millions of dollars. Like let's just say 10 million. That's like pure growth on a company. And there's things you can do from an accounting perspective to help with depreciation or whatever. But a lot of people are dealing with a company that has a starting value of zero, a present day value, or like a present day value of a lot of money. And that's a lot of capital gains. And so life insurance can be an amazing way to take care of that. It can make a ton of sense if there's a corporation to then have the corporation take out a life insurance policy on the main shareholder, and then find ways for them to move the shares to the next generation, but also cover some of the capital gains. So
love it.
A lot of people in their 70s, makes tons of sense for them to put money into whole life insurance. And I look at it as, I've probably used this analogy before. It's kind of like the lifeboat or the legacy. They can set it up such that, if they don't need the money, like set it up as a massive legacy. If fast forward 20 years, they've suddenly got some healthcare expenses they weren't counting on, they can access the cash value as well. So that's like the lifeboat if they need it. But like most of the people I'm working with in these cases, they're like, I did an amazing job saving, like, kind of like their spending habits were on the heels of like the Great Depression.
Yeah, for sure.
I usually did a really great job of saving. Credit was not readily available when they were young, which is really great. So they've saved all this money. They get to the end of their life and they're like, or not to the end of their life, like 30 years out from the end of their life. And they're like, holy cow, like I don't need all this money anymore. And it's going to get taxed like crazy if I pass away with all this money in a taxable environment. So that's like the grandparent story, so to speak.
Yeah, no, I think that's awesome. I mean, and I think that that's a perfect use case of it. And I mean, we see that in the United States as well, where there's, I mean, absolutely a need for that. And so, do you have anything else you want to talk about as far as the need for, or like, you know, the applicability for the older generation?
Yeah, for sure. And I mean, the thing I'll say is that that's different from the States, and a lot of Canadians don't realize is like the tax rate on income when someone passes away goes up to 50% really fast. It's like in the 200,000 range is when someone starts losing for every dollar that gets tacked onto income to the estate, 50 cents of that is going to taxes. The other thing that we've talked about in the past is the capital gains rate in Canada is 50% right now. So capital gains is 50% from $1 when it comes to the sale of something that's appreciated in value. And there is a lot of chatter about them having to raise that in the near future. Or, you know, I mean, I don't want to speculate. Like,
Right.
let's just say, like, right now it's 50%. Right now, your principal residence passes tax free. Those are, and the way that corporations are structured, those are the top three things that consistently get looked at when it comes to tax legislation is, are we going to make corporations less efficient? Are we going to make the principal residence taxable, or are we going to change the capital gains inclusion rate? I have no idea. Like for years, people have been saying the capital gains inclusion rate was going to go up to 75% or more. Hasn't happened yet. It may or may not, but it's already high. Like it's already high.
How do me like this may be a stupid question, but how are RRSPs taxed on from an estate perspective when somebody passes on, say somebody's in their 70s and they have $1 million in an RRSP? Are those non-taxable or taxable?
100% taxable because you got a tax credit on the money going in. So I'm just going to give an example of like if someone passes away, this is a slide I've shown probably dozens of times over the last few years. So you've got a person who passes away in the year that, you know, let's say they pass away in the middle of 2021 or whatever. Mm-hmm. So they've got like whatever they got for their pension that year is going to be income. Mm-hmm. Whatever they got that year from government benefits, like up here we have a thing called CPP and OAS. Then, you know, what else could it be? Any other? I'll just tack on the RSP. RSP oftentimes looks like this massive thing that gets added to everything else. Gets tacked on. 100% taxable to the estate, like not even capital gains, just like every dollar of that is going to be tacked on. So what I say to people is I'm like, and I mean, a lot of people will lose. A lot of people, it's going to do this. It's going to be split right down the middle. And half of it's going to go to their kids and half of it's going to go to taxes for a lot of people.
Is that based on your current income tax rate, right? So like if you're, or like whatever the person who's inheriting the money, is that a tax rate, or is it based on the rate of which the person who passed away's tax rate was?
The person who passes away, so the idea is that someone passes away, there was a deemed disposition of everything they own. The minute before they died, they sold everything they own at that instant. Yep. And the RSP gets tacked on as 100% income. So if you've got $1 million in an RSP and someone passes away, you're losing half of that. Like easily.
500 grand of it's gone.
500 grand going to taxes.
So if you're 70 years old, so just to solidify this point and the importance of using whole life insurance in this situation. If you have $1 million right there, you could pay, I don't know, let's just say you're 72 years old, 73, whatever, and you're insurable. You could go pick up a premium for $30,000 a year or something, probably, maybe even less. I don't know. I don't know what the rates are like looking like at that age. And like, obviously it's massively dependent upon insurability and a lot of different variables. But let's just say you could go get a policy for 30 grand a year, and that policy accumulated a little cash value, which was fine. But let's say you actually bought it more for the estate preservation kind of, angle, making it more about life insurance, not the cash accumulation, which is what I usually talk to people about. But if you do that from the perspective of saying like, I want to make sure that I have this policy that gets, say, $700,000 in death benefit or $600,000 in death benefit that will cover your it cover the premium that you put in plus the taxes that you're going to pay. If you can figure out that algorithm, now you can really pass on a pure $1 million, right?
Yeah, absolutely. And that's exactly what I work with people on. We've talked about this a little bit in the past, where if they've got their money in their RSP and if they were to pass away, they'd lose about half, taxes versus loved ones. What we look at, and with RSP, you actually have to start taking out a minimum amount in your 70s. So you're forced to start taking it out. The idea, and you have to take out more every year. It's based on a formula. So what I say to people is, I'm like, do you like this 50%, 50%? What would you, if you had a magic wand, what would you send to your loved ones versus taxes? And as always, I understand why we pay taxes. I get it. But most people are like, yeah, I know what my favorite charity is going to do with the money. I know what my church is going to do with my money. I know that my grandkids are going to have a better life in an increasingly more difficult world to buy a property, to own your first home, all those things. I'm going to set them up for success. Most people say, well, I'd like to send as much as possible to my loved ones. So what we do is we just do this right off the bat. We're like, okay, what is that amount you're going to be forced to take? How much of it do you actually need? A lot of people, if they've done a really good job of saving and they've got other things going on with income, a lot of people say to me, like, I don't really need a lot of this, if any of it. And it's a good place to be in theory. Like, you've got more than you need, which is fantastic. We take that and we put it into a premium and we get as close as we can to that 50%, such that instead of that 50% going to taxes, like this 50% can like swoop in and take care of that. Okay. So the whole thing goes to the loved ones. So, and yeah.
You guys do anything with annuities up in Canada?
Yeah, I mean, annuities are good for someone who wants to take their income and turn it into a consistent cash flow. RSPs and annuities are a bit tricky because there's no tax advantage of having an annuity inside of an RSP. So I always run the numbers on those. I look at the taxes, I look at the cash flow, all those things. It has made sense for my clients every once in a while, but it's a little bit on the rare side.
It's a little different in the United States for annuities than.
I think so. Yeah. From what you've said of annuities in the past, they sound a bit different down there.
I think they're probably more beneficial in the United States than they are in Canada, based on what you're saying. You can have an annuity in a qualified account and get guaranteed cash flow from it, have it in a qualified account like an RRSP. And like, if I wanted to say, hey, I know that I have $1 million and I know that out of that $1 million, I want to create a certain amount of cash flow. Let's say it's let's say it's 50,000 a year, 5%, right? In cash flow that I need to get from this, and I want to guarantee that for the rest of my life. What will happen is you can go get, I mean, there are different types of annuities you can use, but like, let's say you went and got a SPIA. A SPIA will say a single premium immediate annuity you can get inside of a plan. You can take that annuity, and based on your age, life expectation, all this stuff, they're going to guarantee you income. The older you are, the higher the rate of return that you're going to get on that guaranteed flow based on the amount. So I could take a smaller portion of that, because let's face it, you don't care how much cash you have. You care about what that cash is going to give you for the rest of your life. Right? So you could take the SPIA, guarantee your income that you know you need to live, and lock that in on a guaranteed basis, and then take the rest of it, buy life insurance with it, and then boom, handle the legacy part. And now everything is literally solidified on a guaranteed basis. That's how we can use them in the United States.
Yeah, I mean, actually, honestly, we can do that in Canada too. Like what you're saying, we can do an indexed annuity inside of a registered plan, knowing that a certain amount is going to go every year towards life insurance premium, a certain amount is going to go towards the bank account. Yeah, right. No, so yeah, we can definitely use those in a similar fashion.
It's a pretty powerful way to handle it.
Yeah, I mean, if someone wants guaranteed cash flow for the rest of their life, it's a pretty solid way to do it. And then when you back it up with a life insurance policy, you're just stacking it. Like you're stacking the guarantees, you're stacking the benefits, for sure. Yeah. So for the right kind of person, absolutely, that can work. Yeah.
All right, so let's go back to this.
Back to the kids.
Yeah, let's talk about kids, man, because like I'm really passionate about this. We're actually on a new program with some software that's helping with with kids and stuff. And so I think it's a conversation. I think it, like you mentioned it, if we just had a generation of parents say, okay, when my kid is born, I'm going to buy them a policy, and here's why, and you go through all the benefits, and I'll let you just get into it in the way that you want to talk about it. But
yeah.
It
Yeah, and I
literally
mean,
would change the way it would change our world, literally.
yeah.
It would change everything.
Oh yeah, and I think the thing that I'm facing is that I think people are taking out less life insurance on their kids than before. And I think it's in part because life insurance agents, quote unquote, don't really exist like they used to. People who do life insurance usually do investments, at least up here. They usually do kind of everything. And I think a lot of people, a lot of financial planners, advisors find the money conversation a bit more exciting or maybe a bit sexier to
Yeah.
like, oh, this is what I can do for your rate of return or whatever. And it's like, yeah, that's cool, but this is also really awesome. And I don't know, that's my opinion. Like I wasn't around when that shift happened, but like you used to have like the old fashioned life insurance agent who was like knocking on doors and making sure all the kids had life insurance. That doesn't
Yeah.
exist anymore because we can get paid on so many different things that I think some people really gravitated away from the question that has anything to do with a taboo subject like death, which is unfortunate because I think that the average person is being, they're being left out, unfortunately. And so I'll talk about the kid side of things. We're both passionate about that. My kids probably have more life insurance than I'd say 97% of the population because I believe in this stuff so much. Like it makes so much sense for them.
Yep.
Now, quick thing I'll say though is like when it comes to the structuring of these, we're talking about the grandparent and then the son. I'm going to try to draw a lever and I hope it comes out like halfway decent here. Is that like there's a lever you can move when you're structuring a policy and you can either move it towards cash value or you can move it towards estate benefit. And when I remembered to email this guy after he had talked to me, I was like, oh man, because he's like, do you see anything wrong with what I'm doing? And I'm like, unless you show me all the numbers, I can't really vouch for anything. I was like, in theory, yes, it makes sense. Now, the state benefit lever, like that's the case of this grandparent versus the grandkid is like cash value versus estate. You have to see which one makes the most sense. And getting that wrong can be really a painful, like when I see people come to me and it's been structured improperly in the past, it can be a difficult thing to like handle because I'm like, man, this is a bit of a bummer, like especially for kids policies because they have so many years ahead of them and the difference in cash value between if they had done the maximum cash value versus just kind of let it as the default, it can be really, really different. So
in Canada, are you able to pivot that lever, like switch the lever back and forth year to year, or is it contractually when you put the policy in place, it is what it is?
yeah, when you put it in place, it pretty much is what it is. And that's the defining moment when you have to decide where the premium is going to go. Like, is the premium going to go more towards the death benefit or is it going to go more towards the cash value? Once that decision has been made, it's pretty much set in stone. Like you can't do much after that. And so I definitely encourage people in the last couple of years. The good news is I think advisors have gotten a little bit more like savvy to flipping that switch. I've been using that switch since 2013 when a lot of other advisors were like, I didn't even know we had that switch. And I'm like, well, just show your clients what it's going to do for them. The difference in cash value 20 years out, flipping it versus not flipping it's big. Like it is big. So I'm like, you guys need to start looking at flipping this because I cannot find an ethical reason not to flip it in most cases. Like in most cases, it's like, it makes the most sense for the client. Like, yeah, my commission goes down, but I'm like, my client can retire earlier. Their kids are going to inherit more. It's like it's kind of a no-brainer for most
especially
people.
for kids if you're buying the policy on the kid.
Oh, kids, it's
100% of the time it's got to be that lever has to be towards cash accumulation.
I'd say so. So I mean, so for the kid, really it's a combination of things. One is like the base whole life policy, and the other thing is to tack on their ability to add insurance later, whether they continue to be insurable or not. So it's a guaranteed insurance coverage. So basically what that means is you put a base policy in place and then at different ages, as that kid gets older, they're going to be given the option to increase their coverage because, and I used to train advisors and I had an advisor who was really big on putting like, I think like $50,000 of life insurance in place for kids. And she'd be like, oh, by the time they're 20 or 30, it's going to be 100. And that's so much money. And I'm like, yeah, in 20, 30 years, like $100,000 is not going to be what it is today.
Yeah.
So I'm like
the 50 that you started
with. And they're like, and this person was saying they'll never need insurance again. And I'm like, whoa. I'm like, don't be saying that to people. like most people are underinsured. Like I have millions of dollars of life insurance and I'm not some sort of like wealth baron, like, but when I do the math of what it would take to replace my income, if I were to pass away right now, replace the next 30 years of my income, that's a lot of money, pay off the house. I mean, all the different things I need to do, it's a lot of money. So for a kid today, who knows what kind of insurance they might need in the future? Like, I mean, what if this kid grows up to have like a massive company that's worth millions of dollars? Like they
Right.
might need a ton of life insurance.
Sure.
So setting it up so that at different ages in their life, they get a notification. Hey, did you want to bump your coverage up? You don't even have to, do any sort of underwriting. Just say that you want it and start paying for it, and it's yours. And just keep doing that. That's a big thing for me. Is you've got the base of the whole life, and then these are term additions that can be converted as well down the line. So it's a great way to lock away the insurability. I know people whose children became uninsurable even like before the age of 10. I mean, kids, unfortunately, some kids, unfortunately, they have health issues that insurance companies look at and they say, we can't in good faith insure this child. And if you lock it in, like you were saying, it's usually like 15 days after they're born, you can get that life insurance going. You lock it in, they have some scan that comes back weird on their first birthday. It's like, I mean, like from the health perspective, you have to manage that.
Yeah.
But from the life insurance perspective, it's like we already signed a contract that we're going to be adding insurance to their policy like 8 times. Like it's multiple times over the life of that policy.
All
so
right.
yeah.
So 2 things to that. First of all, well, 3 things. So because I know how it works in the US, I just want to like clarify on the Canadian side. So is there a rider that you're putting on this to for them to guarantee that they are allowed to add insurance? And are they allowed to add only at specific benchmarks, like at age 5, at age 10, at age like whatever, and is there a limit, like they can only double the amount, or they can only, like, how does that work?
Yeah, for sure. Good question. So it is something you have to set up actively. It's a rider that you have to actively add to the policy. It is going to be multiples of the base. So it's like, if you get a 50, well, I'm just going to use rough numbers here. You get a 50, that means you can do multiples of 50 later down the line. There is an age range, it's usually like a birthday. Off the top of my head, I don't know the exact birthdays, but let's say it's like your 20th birthday, but then you also have a range before and after that you can exercise it. So it's something you have to pick up front. It's going to be multiples of the base policy. And you have a range of ages when you're given that option to exercise that increase.
Perfect. So that's that. What else was I thinking? So on the other side of it, are there living benefits on these for kids?
Yeah, for kids, living benefits you mean like what I was talking about the other day, like critical illness and stuff like that?
Critical, chronic.
Yeah, critical illness is a separate policy. For
most Canadian plans.
There might be some companies out there that I think mingle them a little bit, but with my clients, what we do is we do a critical illness policy for the kid, and we do a whole life insurance policy with the term riders. In the critical illness policy, we do something similar where they'd be able to, like, you can do a lot of really cool stuff with critical illness. We did a whole video on that, so definitely that was awesome. You can get all your premiums back if you don't get sick. You can lock in like different amounts. I mean, it's a really fantastic product for kids as well, and it covers extra illnesses that children tend to get. So when someone locks it in as a kid, it's just phenomenal because, I mean, from a statistically speaking, it's harder to get critical illness coverage than life insurance because the underwriting is more extensive, because you're more likely to get sick than die in life.
That must make the insurance charge cheaper in Canada than the United States, is my guess, just actuarially speaking, because what I can tell you, one of the reasons I love this for kids in the US specifically is because all this stuff that you're saying, you can get these riders, do the guaranteed increase in insurance, all these different things. It works very similarly to how you're saying.
Yeah.
And you get living benefits inside of the policy. So if I had $100,000 policy on my kid, right? Like, so for instance, I got a $250,000 policy on one of my kids, right? And so like, if she becomes critically ill, we have access to 90% of the death benefit to use on medical coverage or to use on anything that we want. So imagine, like, and this like really hits home with us right now, because Hannah's dad, my wife's dad, my father-in-law, was diagnosed with stage 4 pancreatic cancer. They gave him 90 days to live, right? Wow. We used money from the living benefits of his life insurance policy to help pay for the charges of all the alternative treatment stuff that we're talking about that's costing $10,000 a month in a lot of situations for alternative treatment out of pocket. Most people just can't afford. So what do you have to do? You have to go in, just get your chemo, listen to your
Oncologist.
oncologist, and follow that plan and get pumped full of drugs and chemo and radiation. And that's the stuff that ends up killing you. And so, being able to have the flexibility to use alternatives. And I know as a parent, the last thing that I want is for some tragedy to happen to my kids where they get diagnosed with leukemia or cancer or something like that. And at 9, 10, 11 years old, have to put them through a system, not be able to afford any kind of treatment that I feel is best for them. You know what I mean?
Oh, for sure.
So I think in Canada, making sure you have a critical illness policy on your kids is imperative. And I think in the United States, the fact that a whole life policy has it, you get the best of both worlds. You get the cash accumulation, the fact that you can literally set your kids' financial freedom up for them from the day they're 2 weeks old. And you have the accelerated benefit riders, we call them, the living benefit inside of
that. I mean, what I will say is, like, for terminal illness, you can get at the death benefit. Critical illness in Canada is slightly different than terminal. Terminal is when a doctor has said that you have a shortened life expectancy, and there's certain, parameters by which someone can access the death benefit. Critical illness is different. Like, critical illness can cover someone even if they have an illness, even if that illness is not likely going to shorten their lifespan. So, like, for example, or something well, I'll give an example. Like, childhood leukemia is usually fairly, survivable, but that's one of the things that can pay out. Or like, as an adult, a lot of heart attacks are not necessarily terminal, but they are heart attacks, right? Or like a lot of types of cancer are not terminal, but they're still cancer. And so those things or a stroke, sometimes someone will have a stroke and they'll still live, and maybe it won't affect their life expectancy, but it'll affect their quality of life. So that's when critical illness pays out. And then with life insurance, you can access a portion of the death benefit if it's a terminal illness. So there is that. Yeah, for sure.
Okay, cool.
Yeah. So, I mean, just what I'll say about this then is, again, the lever for kids, it makes a lot more sense for the lever to be towards the cash side of things. It gives you so much flexibility when the advisor has flipped that lever, because it is, you can offset it earlier if you want to stop paying for the premiums earlier. You're going to have more growth. It's so many benefits. You're going to have way more cash value 20, 30 years out than if you hadn't flipped the lever. Like I said, I rarely see a case where it doesn't make sense to flip that lever. And unfortunately, a lot of advisors don't even know about it. Like, I talk to people are calling me up and they're like, how does that thing work again? And I'm like, what do you mean that thing? Like, that thing I do every time. Like, someone gets a life insurance policy. Like, I know what that is.
So in Canada, is there a best practices or kind of a rule that most insurance companies follow? Like, I know in the United States, you're not allowed to have more insurance on your kid than you have on yourself. Some companies, it's like you can't have more than 50% the amount of insurance on your kids as you have on yourself. So what does that look like?
Yeah, sure. So when you do a kid's application of critical illness or life insurance, they're going to ask how much insurance the parent has. And if the parent doesn't have the insurance, they're going to ask why. So, I mean, for example, if a parent is uninsurable and they want this type of insurance on their child, I don't think there's a problem with that, but they just want to make sure it makes sense. Like, the adult is the one making the money. It is the person in the family that's like running the economic engine usually. So they do want to make sure they're protected against the similar things. So I mean, you have to keep it in line with what makes sense. So like for my own kids, when I got them their life insurance policies, the underwriting was a bit more intense on the financial side than it would have been if I had gotten a smaller, like, if I get a $25,000 death benefit policy,
they just jam it right.
That's just standard. Like, that's 15, 20, like 25 is pretty standard, I'd say. I was getting much more than that, and so they were like, all right, let's see a little bit of financials. They had a new family doctor, so the family doctor, this is actually kind of funny, like so they were just about to change some tax laws around life insurance, and I had like a week to put the application in. And we had just changed family physicians. So our family physician had never met my kids. And she's like, I can't sign off on their health, even if their charts look great. I've never met these kids. And, and I get it. Like, her professional advice was on the line, like, all that stuff. So I'm like rushing to get my kids down there. Like, I'm like calling and I'm like, can we get an appointment on Thursday at 2:00? And I'm sure they're like, why does this, like, this is kind of weird that this guy's rushing to get this done. I'm like, no, the tax laws are about to change. I want to get this in now. And it was good. Like it forced me, like I for years have been saying, oh yeah, I'm going to take out these big policies on my kids. And I kept putting it off, kept putting it off. And then finally when some changes came through, I did it. Now the good news is the companies adapted to that change far better than we had expected. So it's actually still, it's, I mean, in some ways, even if I had waited, it still maybe even would have been better because they got much more fine-tuned with that flipping of the switch than they were before. So it's all good. If you're thinking about this, it still makes sense even after the changes that occurred. It probably makes even more sense. But yeah, I was like rushing down there to get this done, and it did take a little bit more than if I'd just done like a 25,000. They would have been like, sure, tell us about the health of your kid. We're gonna call the doctor. They're gonna say whatever. But this was more involved. Like the doctor had to fill out a form of like, this is the child's health, because they want to know, like they're taking out a lot of life insurance. That's something they may have to, they may have to pay out in, 100 years,
Yeah.
like my kids may live to be in their well into their hundreds, like that's something the company has to sign off on for a really long time.
For sure. No, that's awesome. So is there anything else on the kids side that you think we need to cover? I'm trying to think.
I mean, I just say like, it's just such a man. And I mean that we haven't even talked about the borrowing and we won't get into that, but like, it's just like, imagine like, one advisor I talked to once had this cool thing. He's like, if you wanted to borrow $50,000 today, how many times would you have to pick up the phone to make that happen? It's like, well, if you wanted to get it from a bank, it would not be easy to borrow $50,000 from a bank. Cash value life insurance, easy. It's there. Like if you need to borrow it for, like I had a buddy who was pretty cool. He had a presentation of all the different times he'd borrowed against his insurance policy. So like he borrowed it to like buy his fiance's engagement ring.
Yep.
Then he borrowed it again for like the kid's school. And then he borrowed again here. Like it's just, it's a phenomenal way to have some money in your life when you need it without having to jump through practically any hoops. It's like, that's my money. It's sitting there. I can borrow against it when I need it. So, I mean, I'd say that it's just an underutilized financial tool, completely underutilized in general. And for the right people, it just makes a ton of sense.
So good, man. Awesome. Well, guys, I hope you found value in this. If you did, make sure you please hit that like button. The YouTube gods love that sort of thing. And if you haven't already, make sure you subscribe and hit the bell. That way you get notified every single time Galen and I make a video. We try to do this every week with content specifically for Canada, because you're up in Toronto area, right? Yeah. So,
yep. East of Toronto, between Toronto and Ottawa.
Exactly. So, that it's the world up there is a little different. We started this series simply because there's a ton of information out there on YouTube in regards to helping United States people with all the ways things work down here. It was seriously lacking in Canada. So we're just doing this to serve. So if you have any like specific topics or questions or anything, go ahead and put them down in the comment section below. We will engage with the comments. I know Galen checks the video threads as well. And we will make sure to, if it makes sense, we will make a video on the topics that you have the needs for. We are doing this series to serve people. So if you have any questions about anything, you can get on a call with Galen. The link will be down below to set up a call with him. And it's pretty straightforward. So until next video, guys, I hope everybody has a blessed, inspirational week, and we'll see you next week. Take care.